Today we're going to talk about Chapter 2, which deals with terminology called debits and credits. And we're going to specifically analyze and record business transactions. Now, last week we did that in a little different format using the accounting equation. Today we're going to introduce something called T accounts. T accounts. So T accounts are going to be forms used for various accounts that are affected by different transactions for a business. So, first one, this is something you must memorize, and it's going to be confusing for you from time to time. But again, I want to emphasize the fact that for a T account, which looks like this, a big T with the account name at the top, the left side of all accounts is the debit side. Left side, debit. Right side of all accounts is credit side. Right side, always credit for all accounts. So left side debit, right side credit. Now, some more terminology that we're going to talk about as we deal with business transaction is to foot a T account. A foot simply means to compute what is on each side. So if there were several transactions that affected the debit side of an account, you would have to add them up to see the total amount of debits. The same is true with credits. You would total them up. So what we're going to do now is take a little bit more look at T accounts and what value they have to this whole process. First of all, the rules of T accounts. First one, and again, you'll have to memorize this part. And then I'll show you how it fits actually into the accounting equation. Assets. All assets increase on the debit side. So to increase an asset, you would have to debit that account. Okay? So give me an example of an asset. Cash. So if the owner is investing cash in the business, you're going to debit cash. Make sense? For every debit, there must be an equal credit or credits. So if we're going to debit cash, what account would we credit? Investment. Remember when we did business transactions last time? What would we credit, or what would be the other account impacted by an investment of cash in the business? Capital. So, debit cash, credit capital. Asset accounts increase on debit side. Capital accounts increase on credit side. Now, does this make sense? Take a look here. What is on the left side of the accounting equation? Assets. And assets increase on which side? The debit side. And the debit side is on the left. So another way to remember, assets increase on the left side or the debit side because they're on the left side of the equation. Owner's equity, capital is part of that. It increases on the credit side. Is that which side of the equation? The right. Therefore, the right side of the account or the credit side. Haven't done this one yet, but liabilities. How do you think a liability account will increase? On the credit side or the right side. So basically what you need to remember is how accounts increase. Do you have to debit them or credit them? And we're going to do a lot of practice with this so you'll become familiar with it. And then I'll give you some little ways to try to remember also what's the increase side for any account and what's the decrease side.
I know we haven't got to it yet, but revenue and expenses would still be on the right side, correct?
Good one. She's saying revenue and expenses fall under owner's equity, correct? If capital increases with a credit, because it's on the right side, does revenue increase capital? Yes, so therefore it would also increase with a credit. But expenses do what to capital? Decrease it. Therefore, they're going to increase with the opposite, or a debit. But we're going to go through that, okay? But thanks for bringing that up. Okay, let's go on. The first thing you do when creating T accounts and working with them is, besides creating them by drawing a T and putting the account name at the top, is to identify accounts that are affected, just like we just stated. If you're investing cash in a business, the two accounts affected are cash and capital. What if you're buying supplies on account? What two accounts would be affected if you're buying supplies on account? Assets specifically would be supplies and accounts payable, or the liability account, accounts payable. So those two. Now, if we're going to increase an asset, are we going to debit it or credit it? Debit it. And if we're going to increase a liability, what are we going to do? Credit it. Remember, debits for all transactions must equal credits. Okay? Step 2, we just did classify these accounts into either an asset, a liability, revenue, expenses, or there's another one that could go in there. Withdrawals also comes under that umbrella for owner's equity. Step 3 is to identify the location of the accounts in the equation. All of these will help you in determining whether you're going to debit the account or credit the account. All of these will help you. Now, again, repeating, debits must equal credits for every transaction. Can you have more than one account debited? Yes. Can you have more than one account credited? Yes. As long as the total for all debits for that transaction equal the total for all credits. And we'll talk about that as we get to that. Okay? And again, this is just repeating the things that we just talked about. So think about this without necessarily looking at your notes or looking at the board here. Tell me, a liability account will increase on which side? Credit. Good. How about supplies? Where would that increase, on the debit or credit? Supplies would increase on the debit. How about owner withdrawals? You'd think it's credit because it's this side of the equation. But it decreases that capital account, so it's going to be a debit. Just like expenses is a debit, withdrawals is also a debit. So let's identify all the major categories. Assets increase with a debit. Liabilities increase with a credit. Owner's equity or capital increases with a credit. And under owner's equity, we have revenue, which is going to be a credit because it's going to increase the capital, and expenses, which are going to decrease, so they're going to be debits. And what else did we just talk about that decreases that capital? Withdrawals. So again, I just used my hand to identify the correct balance side for all the types of accounts. So let's repeat them again. Assets equal liabilities plus owner's equity. Owner's equity is the capital account followed by revenue and expenses and withdrawals. Now, if I put my thumb and little finger together, these are all the accounts that are debit balance or increase by debiting them. What are they? Assets, and what's the last one? Expenses and withdrawals. These all increase by crediting them, and they are liabilities, capital, and what's the one following capital? And revenue. Good. So you have a cheat sheet with your fingers right now to remember the balance side or the increase side for all accounts. Assets equal liabilities plus owner's equity. Under owner's equity, we have revenue and expenses, and then, of course, withdrawals if there are any. Bring these two together. These increase with debits. The rest all increased with credits. Those are what you must memorize. You must memorize and understand them in order to do all transactions. And it'll take some time, but we'll get lots of practice doing so.